Welcome back to Mia Wealth Hub, your trusted space for all things finance. In today's video, we're diving into two of the most powerful forces that shape your investments: interest rates and inflation. Understanding how these affect your portfolio is key to making smart, informed decisions as an investor. Let's get started. Interest rates and inflation. These two concepts might seem like they only affect mortgages and prices at the grocery store, but they also play a huge role in your investments. Today, we're breaking down how interest rates influence your returns, how inflation impacts the value of your money, and why you need to understand real versus nominal returns when tracking your investment performance. Interest rates. Let's start with interest rates. At the most basic level, interest rates are the cost of borrowing money. They're set by central banks like the Federal Reserve, and they impact everything from the cost of loans to the returns on savings accounts and bonds. When interest rates are low, borrowing is cheaper, which encourages businesses and consumers to spend and invest more. But when rates are high, borrowing becomes more expensive, which can slow down the economy and reduce demand for investments. As an investor, interest rates directly affect your returns, especially in the bond market. When interest rates rise, bond prices tend to fall. This is because the newer bonds being issued offer higher yields, making older bonds with lower rates less attractive. On the flip side, when interest rates fall, existing bonds with higher yields become more valuable. Inflation. Next up, let's talk about inflation. Inflation is the rate at which the general level of prices for goods and services rises, causing purchasing power to fall. In simple terms, as inflation increases, your money buys less. For example, if inflation is 3% per year, something that costs $100 today will cost $103 next year. If your investment isn't growing faster than inflation, the value of your returns is essentially being eroded. That's why it's crucial to invest in assets that have the potential to outpace inflation. Inflation is especially important for long-term investors. If inflation consistently outpaces your investment returns, you could lose purchasing power over time, even if your account balance is growing. So, it's essential to choose investments that can beat inflation over the long run, like stocks, real estate, or inflation-protected bonds. Real versus nominal returns. Now, let's break down real versus nominal returns. This is one of the most important concepts when evaluating your investments. Simply put, nominal returns are the raw returns you see on your investment without adjusting for inflation. For example, if you earn a 7% return on your investments, that's your nominal return. However, what really matters to you as an investor is the real return, the return adjusted for inflation. If inflation is 3%, your real return on a 7% nominal return is only 4%. That means, after inflation, your money is only growing by 4%, not 7%. In other words, real returns give you a clearer picture of how much your wealth is actually growing, considering the rising cost of living. To ensure your investments are working effectively, aim for a real return that outpaces inflation over time. Putting it all together. Now that we've broken it all down, let's put it together. Interest rates influence everything from the cost of borrowing money to the value of your bonds. Inflation erodes the purchasing power of your money, and understanding how to beat inflation with your investments is crucial for long-term success. Finally, when you're tracking your returns, always look at your real returns. That's the true picture of how your investments are performing in the face of rising prices. By understanding how interest rates and inflation affect your investments, you can make smarter choices and keep your money working hard for you, even in uncertain economic times. Do you have any questions about how interest rates or inflation affect your investments? Or maybe you've had experiences with this yourself? Drop a comment below. I'd love to hear from you. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss out on more tips from Mia Wealth Hub. Thanks for watching, and I'll see you in the next video.